What's going on, my friends? Welcome back to another property update video. And today we're going to keep things really short because I've only got 3 articles that I want to run through with you. And I just want to run through some things that I think are going to be quite important for you guys to know. So of course, guys, if you get a chance, do check out this video here on the UK recession. It's a very short one. I tried to make it under 6 minutes and it gives you 10 tips on what you guys should be doing during a recession. And of course, there's hundreds of other videos on this channel to help you not only invest, but also buy your own house, start a business, save some money, and just hopefully do well for yourselves in the near future. So guys, let's quickly jump into this. So firstly, the question that's on everyone's mind, is the drop in house price an indicator for looming property market crash? Now, every month that I do these videos, we've seen the house prices rise. However, in July, things changed. July marked the first time that UK house prices have actually fallen in more than a year. However, the average price of a home is still £293,221. Almost lost my trail of thought there, which actually shows a 0.1% decrease month on month, according to a recent report. But what we can't forget, this is still £30,000 higher than it was last year. So yes, we have now for the first time seen house prices falling. They're still incredibly high. And the Bank of England has announced its biggest increase, something I mentioned, I think, on the last update video in relation to its interest rates. So I'm sure many of you are up to date with that. And essentially we know properties in the UK are now more unaffordable than ever. Again, I did touch on this in the last update video, so do go back and check that if you want, my friends. Now, this was quite interesting because here we have David Hanna, who speaks about not seeing a property market crash in 2022. And he essentially says that he doesn't believe we're going to see the crashes that people have predicted, like the 20, 30 or even 50% falls in house prices. And I'd probably agree with that. You know, I sit here and I say there's probably going to be a bit of a correction. We're going to see house prices slowing down, cost of living, all that sort of stuff that's going on in the world today. But I do think we might get a slight dip, 5-10% here and there, 15 at a push, maybe in certain areas. But yeah, I can't see a 50% crash myself. But again, guys, nobody truly knows. And what he says here is if we look at the pressures that's been going on, i.e. house price growth, retail inflation, energy costs surging, it is going to put a pressure on employees to raise wages. And this is quite interesting and not something that I've ever touched on these videos, is that he believes that wages will begin to rise again, meaning real spending power may not actually decrease as much as we are at least thinking based on all the information that we have today. Everything is becoming so much more expensive. So it's going to be interesting if that does materialize. However, he then goes on to say a couple of things that I think are important, my friends, is the problem we have is the rate of demand and supply. We're all pretty much aware of that. And if builders are building and they're oversupplying, it will soften the increase and the appreciation in asset value. Now, I don't think we're going to build 300,000 houses, which is pretty much what we estimated that we need right now. But if the number of people wanting to buy a house continue to exceed the supply, then of course the prices are going to rise. But what he then talks about is that if people domestically may not be able to purchase it and that demand cools, international buyers could still contribute to keeping prices high, which is interesting because you're going to get a lot of influx from foreign investors coming in, then could that at least keep the property market where it is? Who knows, my friends? Let me know in the comments what you think. And then another one which I've just highlighted the crap out of, my friends, is are slowing house prices good news for Britain's generation rent? Don't hold your breath. Now, this is a great article and it actually has some really good points. But essentially what she says is, as you can see here, don't reach for that champagne just yet. Although the average price fell by £365 in July, it's still £30,000 higher than it was last year. And then just moving on just ever so slightly, according to a trade body, UK Finance, 2 million homeowners on variable trackers, I'm surprised there's that many people on variable or tracker mortgages, will see an automatic increase to their monthly payments. And this is a kicker, my friends. Another 1.8 million households on fixed rate mortgage deals that expire next year, so 2023, will be paying an extra £2,664 a year on average. And if we add that to your gas bills, your petrol bills, your food, pretty much all types of bills, my friends, it's going to be interesting. It's going to be interesting and I do worry somewhat. Then essentially it goes on to say Britain is poised to enter a recession this year. A video I did release. Guys, do check out my shorts. I do try and bring up-to-date news as quick as I possibly can. And at the same time, investors with large cash piles may take advantage of any downturns to hoover up properties on the cheap. This is essentially where having cash in a recession, as I mentioned in that video, just here, just a quick cheeky plug, it's really important, my friends. And yes, I was that sad when I was doing the video. And moving on. So the article then goes on to say, British political leaders have a habit of throwing money at the housing market when it suits them. Well, obviously there's probably a selfish reason for that, but also the banks need to lend money. And we've had the Help to Buy scheme under David Cameron, we've had stamp duty holiday under Boris Johnson. But what if this was to be turned on its head? Could this mean a prolonged period of stagnant house prices where transactions fall and the market grinds to a standstill, or even more severe, a price shock? Interesting. It would be very interesting if that happens. And finally, my friends, just before we close this very, very short video, how will a recession hit the UK housing market? So this is just something obviously to be mindful of, friends, as we head into Q4. This will be the first UK recession since 2020, the height of the Big C crisis. However, that actually boosted property prices as working from home encouraged both house movers and buyers in this whole race for space. I'm sure you remember that terminology. I've definitely used it before on this channel. But one thing we need to be mindful of is repossessions may increase as people struggle to pay for the increased cost of living and the mortgage payments, and therefore more stock may find its way onto the market. Interesting from a mortgage expert. Now let's quickly talk about getting on the property ladder before we close. The biggest risk for hopeful home buyers in a recession is losing their job. I think that's pretty much common sense for all of us. And the property website Rightmove has calculated that first-time home buyers would see their monthly mortgage payments climb to an average of 40% of their gross salary after the week's rate rise. So imagine losing your job and then come 2023 or come refinancing, you've now got more bills, higher bills to pay. It's not going to be great, and it could definitely cause problems with repossessions. So it's definitely something to just be mindful of in the back of your head. And we will touch on something that you can potentially do. And by the way, this isn't financial advice, my friends. It's just something that you can potentially do. So let's talk about that. Coping with mortgage rate rises. One simple way to help with potential future rate rises is fix your mortgage. Now, a lot of people ask me, should I fix my mortgage? I'm not a financial advisor. It's definitely not something that I should be even speaking about with yourselves. However, what I would say, what I used to do was I used to take out 2-year mortgages because I'd always change the rates or at least see the most competitive rates available. However, recently in the last year or so, I've been fixing everything for 5 years. Now, this article reckons that this could potentially help. I've told you what I do, and you guys have really got to make your own decisions. And just as we finally close falling property values, if this does happen in isolation, it could be good news for potential home buyers. I think we can all agree on that. But existing home buyers face a potential risk that the value of their home could end up lower than the amount that they borrowed. And that, my friends, is negative equity. A video I have just released on a very small short, something worth understanding and getting your head around, because that's the last thing you want. Now, of course, if you're a long-term homeowner, you should be okay because the value would have outstripped, any dip in sort of house prices. You would have built up enough equity. But that is essentially that, my friends. A very, very quick update. If you find it useful, I'll be very grateful if you smash up that like button. And if you're new to the channel, maybe even consider subscribing. And until next time, my friends, thanks for watching.